criteria in the property, plant, and equipments is that it's need to have a probable future economic benefit from the asset. So what is the meaning of economic probably probable future economic benefit means that if we are using this asset, either we are able to generate revenue from this business, from this asset, or we are able to use directly or indirectly. So it could be used in the sales, it could be used in the production, it could be used in the distribution, or it gonna reduce some cost for the company. So um, it could be table, chairs, aircon for the purpose of ability of the business to run as itself, and save the rental for the rental of the space for the company or for the business. So it's going to be used for economic benefit, economic activities, not for charity, right? So these assets are mostly used for economic benefits from the use of asset to the entity, and they are within the control of enterprise. So it's not like you have given this asset to somebody else as a for their use. Then this asset is not going to be under property, plant, and equipment for us, right? So let's say there is an NGO, you have buy a asset for you, and you have given it out to somebody else, whether for rent or for any other, not for rent, because if you do rent, you still maintain some kind of control over the asset, that you may have a right to inspect, you may have a right to look at the property, or you will have a right to get it back. But if let's say you give it out to them without any control over of the enterprise, you have given them for their use to the tenant, and you don't have a right of on the asset anymore. You will not get it back, you cannot inspect, you cannot repair, there's no control of the enterprise. Then that asset, even though it's owned by the or purchased by the entity, is not going to be the property, plant, and equipment of this particular entity, whoever has purchased it, if they don't have a control on it. And the third criteria is that we are able to measure the cost reliably. There are mostly many times that, let's say, you have built up a building by yourself. So and many of the cost, and you have worked by yourself on the asset, and so the cost is not, if the labor cost is not be able to reliably measure, because you don't know what is the cost you are paying. So that kind of asset cannot be recognized. But let's say, so to recognize as a fixed asset, as a property, plant, and equipment, the cost has to be measured reliably. Means we need to be able to easily say this is the cost of purchase, this is the cost of installation, this is the cost overall, or is the consolidated cost of the property, plant, and equipment, and we know how much we have paid for it, right? Whether in cash or in kind, or and as an exchange of the asset, whatever, however is it, but it needs to be measured, it needs to be clear. If it cannot be done clearly, then you cannot recognize this as a property, plant, and equipment, because uh, only on the cost you can record the PPE in your books. If you don't even know the cost, how what amount you will use for recording the asset, you cannot use the market value. So the impact of this recognition as a fixed asset or as a property, plant, and equipment is that if, let's say, you recognize any spend as a fixed asset, the first impact is that the profit and loss statement will be showing you a higher profit, right? Because if you charge that to profit and loss statement, the expense will go down. You have to pay less taxes and less cash outflow. But if you put this fixed asset into the fixed asset in property, plant, and equipment, instead of charging to the profit and loss statement, you are going to pay higher tax, because you have higher profits. You can show higher profit in the profit and loss statement, but then you need to pay the taxes as well, higher taxes, and also charge the cash flow, and also it will impact your cash flow, right? So the second impact is that on the future profits, because you have put any expense into the property, plant, and equipment, it will continue to charge the profit in the deduct from the profit in future years to come. So your profitability will show lower in those future years. Um Many companies, they don't want to show a lower profit in the future. That's why they charge everything during the setup time or during the initial time when they know that the business is expected to make losses. So they charge everything in the initial years for the simple reason that if they don't put into the property, plant, and equipment, there is no depreciation in the future. So they would be able to show a much higher profit in the future, right? So showing the losses in the initial year is not going to impact the taxability in the future, because you can carry over the losses to the future, and you can adjust in the and adjust from the higher taxes in the next year and save on the cash flow. So that's usually is sometimes the tax planning, you can say, or the profit planning. The businesses do deliberately to show either a higher profit now or a lower profit in the future. If you charge everything into profit and loss account, then the profits will be much higher in the future. But if you if you put into the property, plant, and equipments, it will impact the future profitability because of the depreciation. And also it impacts the revaluation. So let's say you have a business, and everything has been charged to the profit and loss statement, nothing is being recorded as a fixed asset. So means business does not have a fixed asset, does not have a property, plant, and equipment. So when you are reevaluating the business, it will show a much greater a profit, right, a gain on the revaluation reserve. So you might have to pay the taxes on that higher amount. But if you put into the fixed assets, the revaluations will also get affected because of this. One is that there is a clearly you have some assets which needs to be revalued. It may increase the cost of revaluations, plus it will reduce the revaluation reserves, or the gains from the revaluation in the future. It may also affect the revaluation losses, because in the future the loss the if the value goes down, it will cause losses on the revaluation. So there are these three main criteria for judging whether at what amount you should be putting the expenses into profit and loss account, and above what amount you should be charging it to the fixed assets, and how you want to decide what to charge to fixed asset, what not to charge to fixed asset. But whatever you are deciding now, what the business is deciding at this point of time, they cannot change in the future. So you cannot change the depreciation policy or the capitalization policy every year. Otherwise, the results are not comparable year over year. So once you have finalized, you are going to use it for a fairly long period of time. If you change, you can change, but that's all going to be the prospective change, not a retrospective change, and that does not count as a accounting policy change. That's a management estimate change. So when